If you own your home in Australia and you are watching this, stop what you are doing, because what I am about to cover could save you tens of thousands of dollars, or cost you exactly that if you miss it. Most homeowners assume that when they sell the family home, the profit is entirely theirs. The ATO gets nothing, and that assumption is costing people a fortune. Because the CGT exemption that protects your home has conditions attached to it that your real estate agent will never bring up, your bank never explained, and that a significant number of Australian homeowners have quietly breached without the faintest idea it happened. By the time they find out the sale is done, the tax bill has arrived and there is nothing left to do about it. I have been a chartered accountant for over 20 years, and the conversations I dread most are the ones where someone is sitting across my desk having just sold a home they lived in for decades, and they are staring at a six-figure tax liability they genuinely never saw coming, not because they cheated, because 5 specific decisions they made along the way, each one completely ordinary at the time, stripped away part of their exemption while nobody was watching. If the ATO can reach into the profit from your home because of something you did years ago without knowing the consequences, that is as close to taking your home as it gets. So before you rent any part of it, before you move out even temporarily, before you sign anything with a real estate agent, watch this. But the main residence CGT exemption that protects that sale has conditions attached to it that your real estate agent will not mention, your bank never explained, and that a surprising number of homeowners over 60 have quietly breached without realizing it. I'll start with what the exemption actually is, because most people have a rough idea, and the rough idea is where the trouble starts. When you sell a property that has been your main residence for the entire period you owned it, the capital gain is fully exempt from tax. The whole thing. No CGT. But the moment the property was not your main residence for any part of the ownership period, the calculation changes. You only get the exemption for the proportion of the time it qualified. So if you owned a home for 20 years and it was your main residence for 15 of them, roughly a quarter of the gain is taxable. The first thing most homeowners get wrong is the rental period, and specifically the 6-year rule that is simultaneously one of the most valuable concessions in Australian tax law and one of the most misunderstood. If you move out of your main residence and rent it out, you can continue to treat it as your main residence for CGT purposes for up to 6 years, provided you do not nominate another property as your main residence during that period. That 6-year clock resets every time you move back in. So a homeowner who moved out, rented the property for 4 years, moved back in for a period, and then rented it again, gets a fresh 6-year window each time they return. The mistake I see is people who moved out, rented the property, never moved back, and assumed the 6-year rule had protected them for the entire rental period. It does if the sale happens within 6 years of moving out. If the sale happens in year 7, 8, 10, the proportion of the gain outside the 6-year window is assessable. Had a client, I will call her Sandra, sold her family home after being in a rental herself for 8 years. She had moved out, rented her place, assumed the 6-year rule covered the whole period. It covered 6 of the 8 years. The 2 years beyond that window were fully taxable, and on a home that had appreciated significantly, that was not a trivial number. Nobody had told her the clock was running or that it stopped at 6 years, regardless of what happened next. The second thing that catches people is using part of the home to produce income. Running a business from a home office, renting out a room or a granny flat, having a home studio or workshop with a genuine business purpose. The moment part of your home is used to produce assessable income, the main residence exemption does not apply to that portion. It applies to the residential part only. When you eventually sell, the gain has to be apportioned between the exempt residential area and the non-exempt income-producing area. How you apportion it matters enormously, and this is where the records most homeowners have never kept become critical. Floor area is the standard method, but not the only one, and the difference between methods can run to tens of thousands of dollars on a significant property. Pull out whatever records exist for that period before you speak to anyone about selling. The third thing is the timing of the sale relative to your income year. And this is the one where a relatively simple decision can save a significant amount of tax with no impact on the price you receive. Capital gains from a property sale are included in your assessable income in the year the contract is signed, not the year of settlement. If you are selling late in a financial year and your other income for that year is already elevated, a large super withdrawal, investment distributions, other income from work, the gain from the sale stacks on top of all of that and gets taxed at a higher marginal rate. If you sign the contract in July instead of June, the gain falls into the next financial year entirely. Combined with the 50% capital gains tax discount that applies to assets held for more than 12 months, this timing decision alone can change the tax outcome on a significant gain by a meaningful amount. I have seen clients who had already accepted an offer and were about to sign contracts, where a conversation about which side of the financial year the contract date fell on changed their tax outcome by over $20,000. A simple question worth asking before pen goes to paper. The fourth thing is the Downsizer super contribution, and most people approaching a property sale in their 60s or 70s have either not heard of it or have a vague sense it exists without understanding how it works. If you are 55 or older and you sell a home you have owned for at least 10 years, you can contribute up to $300,000 each, or $600,000 as a couple, into superannuation from the proceeds of that sale, regardless of your total super balance and regardless of whether you're still working. Entirely separate from normal contribution caps. The contribution must be made within 90 days of settlement, using the Downsizer contribution form lodged with your fund. For a couple selling a long-held family home, this can shelter up to $600,000 into super in a single transaction. The people who miss it are the ones who bank the proceeds and find out 12 months later the window closed on day 91. The fifth thing is the one that genuinely surprises people, and it involves the relationship between selling the family home, the sudden appearance of a large cash asset, and what Centrelink does with it. Under the assets test for the age pension, the principal home is exempt. It does not count. The moment you sell that home and the proceeds land in your bank account, they become assessable financial assets, and your age pension entitlement is reassessed accordingly. For a retiree receiving a full or part age pension who sells a home with significant equity, the impact on their pension can be immediate and substantial. The deeming rules apply to the cash proceeds from the first day of the following assessment period. A 12-month exemption applies to the proceeds if you intend to buy another home, extendable to 24 months in some circumstances. But the planning needs to happen before you sign the contract, not after settlement when the money is already sitting in your account being assessed. 5 things every Australian homeowner needs to understand before they make any decision about their property. The main resident CGT exemption, and exactly when it applies and when it does not. And, critically, when the clock on it stops running. The income-producing area apportionment, and the records that make the calculation work in your favor. The timing of the contract date relative to the financial year, and the difference it can make to the tax on a significant gain. The Downsizer super contribution, and the 90-day window that closes permanently once it passes. And the Centrelink impact of converting an exempt asset into an assessable one, and what planning ahead of the sale can do to manage it. None of this is a reason to feel anxious about selling or about decisions already made. But every one of these 5 things represents a point where the ATO either gets a slice of your home or does not. And the difference between the two outcomes almost always comes down to whether you knew about it before it mattered rather than after. Do these 5 things before you sell, and the profit from a lifetime of mortgage payments stays where it belongs. I am Alistair Vance, and I will see you in the next one.